My name is Jake, welcome to the channel. In today's video, we're going to do a Review My Pie video where I review subscriber portfolios. So we're going to review 3 portfolios and I'm going to answer 1 subscriber question, and that's what we're going to do in today's video. This last week has been just kind of a normal week, up and down in the market. I don't know about you, but I'm just kind of getting used to these red days. I'm getting used to this volatility, and I'm just kind of prepping myself that this is going to be most likely the new norm for the next couple of years. But besides that, I'm definitely trying to avoid scams. I don't want to get scammed and lose my money. I don't know about you, but if you've been watching YouTube for a while now, you probably have seen an uptick in scam bots. I don't know what it is. You know, someone that creates YouTube videos, I get to see all of the comments that are made on my channel, and I'm usually pretty good at deleting them or blocking them or reporting them. But it is so crazy / funny to see some of these people, some of these scam bots post on YouTube. And it's not just on YouTube, it's on every social media site. So just to throw that out there. But it's so obvious that some of these comments are a scam. Like, what you'll notice is it's usually talking about like Bitcoin or something to that effect, some kind of cryptocurrency. They usually will reference a person like, hey, this person helped me make $15,000 last month. Go and, check them out. And then what's so interesting is how sophisticated these bots have become. Within minutes, it'll have hundreds of likes and hundreds, maybe dozens and dozens of comments. And the thing that's so crazy about these crypto bots is they're sophisticated comments. Some of them will actually talk about dividend investing. And so some of them kind of can trick me as well. It's like, oh, that's a really interesting comment talking about dividend investing, but it's just blatantly a scam. You can see it, there's a lot of like spelling errors in the comments, and you can always know that it's a scam because they use like these stock pictures. Like Brian Mueller, I don't think that this is Brian Mueller, or Terry Russ. I don't think that that's his real picture. These are stock pictures. But what's interesting is it's like an epidemic of these scam bots. And you see that, yes, once again, Bitcoin. And then it's like so crazy how similar they are, and how similar, but yet, like, look, you got Terry West, that's his picture. And you got Terry West, that's his picture there. But where's another one? You got Terry Russ, you got Michael Henderson. So Michael Henderson here is saying the exact same thing as James Fred. Fred, that's a nice last name, Fred. Anyways, just be really, really careful. These scam bots, these in the comment section, just use your brain. If they're ever talking about Bitcoin on my channel, you can just assume that it's a scam or a bot. But even like another one here, like Miss Anna is legit and her method works like magic. I keep on earning every single week with her new strategy. Ooh, I wonder what her new strategy is. Elizabeth Swift. Whoa, okay. All right, Miss Anna. Is Miss Anna her first name or her last name? Is it Miss Anna what? Elizabeth Swift, Alexander. Look at this. They always use like old people pictures or senior pictures. Her info is down here. Yeah, I'm sure that this is how you reach Miss Anna. But yeah, whenever I see these on my channel, I try to delete them the best that I can, but just always use your common sense. Don't click on any links from these scam bots. And whenever I see these bots like in the channel in the comment section, it always makes me think of this.
Sorry about this wind. I can't believe there isn't any wind out here. This is ridiculous.
No, it's great. It's very peaceful.
Hey, Trouble! You ain't moving!
Yeah, need a little wind here.
No, you need to drop a couple hundred pounds, Clip!
Rascals.
Oh my gosh. Oh man, Tommy boy. Oh my gosh. All right. So in today's Review My Pie, we're going to answer 1 subscriber question who's 22 years old. The first portfolio is going to be from a 23-year-old here in the US. The second portfolio, a 33-year-old from Scotland. And then the third, a 48-year-old here in the United States. As always, the timestamps will be in the description below, as well as the portfolio links. As always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, I don't pre-read the emails or the portfolios. I'm not scripting any of this. I'm reading them for the very first time. And yeah, let's dive into the first portfolio here. All right, let's take a look at the question here from David. He writes, "Hi Jake, just wanted your opinion on retirement accounts. I'm currently employed as a firefighter in South Florida and have access to a 457 Roth and traditional. This is, I guess, a government issued account. I'm contributing to the Roth 457, but do you suggest it's a good plan as there are obviously way higher expense ratios?" Okay, obviously. I was considering maxing out the total contribution of $19,500 for the Roth 457 and looking into opening a Roth IRA through M1 Finance at $6,000 a year contributions. But I've been looking into dividend investing through M1 Finance as well. Do you personally think the 457 is a good investment, or should I just open a separate retirement account on M1 Finance instead? Thank you. Looking forward to your thoughts. All right. So this question, really, the answer is different for every single person. This is why this question is so difficult, and so many people have this exact same question, because there is not a one-size-fits-all answer. So that's the very first thing. There's not one answer fits all for every person watching this video. You might have somebody that's in their early 20s. You might have somebody that's in their late 40s or 50s. The answer is going to be fundamentally different. The thing that you have to understand for yourself is you have to understand what is your purpose of using this vehicle. This account, when you say, do you personally think the 457 is a good investment? A 457, a Roth account, a retirement account is not an investment. It's a vehicle. It's an account. You hold the investment in the account. So that's the very first thing that you have to understand. When you hear somebody say, yeah, I invest in my 401k. Well, your 401k is only an account. It's not actually an investment. You hold your investment in your 401k. Do you understand? So it's important that you understand the rules that come with these different investment accounts. So a Roth IRA is fairly similar to a Roth 401k. Now the 457, I believe, is similar to a Roth 401k for your average person who's employed with just a public company, for example. Somebody a public company like a Salesforce or a Microsoft, as an example. What it really comes down to is your age and your goals. If you're over 50, I would say in almost every case, you're going to want to go with the retirement account. If you're in your early 20s or early 30s and you plan on retiring much sooner than the age of 59 and a half, I would say it makes a lot of sense. What my wife and I personally do is we do both. We invest into our Roth IRA. I also invest into my 401k through my employer only up until the match. So I don't invest anything more. Because our goal is to reach FIRE much sooner than the age of 59, we want to focus more on accounts that are going to serve us and help us get to that goal, right? So the way that I always like to look at this, the same way as your investments, like your ETFs, your stocks, that's the vehicle, right? And you have to understand where's the destination. And so you want to make sure you're picking the right vehicle for your destination. And the way that you answer this question, and like I said at the beginning, this is different for every person. What you have to understand is, what is your destination? Are you planning on living off the portfolio after the age of 59 and a half? Then the answer is straightforward. Go max these accounts. If you're in your early 20s, you may want to give yourself a little bit of flexibility, right? But I think these retirement accounts are one of the best ways for your normal person to gain wealth and grow wealth in America. This is one of the best account vehicle to grow wealth in America. So that's my view on this personally. That's why my wife and I, we do both. And so you have to understand what your goals are there and your time horizon is there. And so by answering this the way that I am, I'm hoping to give you enough inspiration to start thinking about it maybe a little bit differently, so that you can then go and do additional research when it comes to the different account types that are available. But bear in mind, an account is not an investment. You hold an investment in the account. And when it comes to the expense ratio, that is absolutely a factor. If, like, for example, my last employer, they were not the best when it came to their 401k. The options that they offered, the index funds had like a 1% expense ratio, incredibly high. And so sometimes you're not always going to have the best options to choose. And so that's why, maybe set your goal of maxing out your Roth first and then your 457 Roth account, because you can pick the investments within it, the investments in the account, and then to approach it that way. In some cases, you just don't have any other options to pick higher expense ratios, expense ratio index funds or mutual funds, whichever are available in your plan. But that's something that I would be aware of. I like that you're aware of the high expense ratios, that you understand the importance there. Make sure that you're not just basing your decisions off of one component of that. You really want to look at the big picture, and the way that you look at the big picture is look at your destination. What is your goal with it? What is the purpose for having this account, right? And that's how I would approach that. And that's how I would answer this, whether you're 20 years old or 50 years old. So, David, I hope that helps. I'm sure that there's thousands of people out here watching this video that are in a similar boat or have a similar question, and that's how I personally approach this. But one last thing, if you're unsure of what to do, the best thing that I would recommend is take a hybrid approach, like maybe look at it and do a little bit of both until you figure out what your destination is. Hope that helps. Thank you so much for the question, David. All right, let's take a look at the first portfolio. It's from Adam. He writes, "Hi, Jake. First off, I love your videos and think you do a great job with all of your content you create. Keep up the great work." Adam, thank you so much, man. I really, really appreciate you saying that. My name is Adam. I'm 23 years old and currently a full-time student in graduate school for physical therapy. I started this portfolio several years ago with a similar mindset of generating a passive stream of income over time that I can live off of in retirement or subsidize living expenses in the future in your 30s or 40s. However, as a full-time student, it has been challenging to fund my portfolio, but I work several side hustle part-time jobs to scrap together some cash and always try to stash some away into this portfolio. Although I currently don't have a lot invested in this portfolio, around $6,500, I want to have a good planned starting point in mind so that when I do begin a full-time career, I can fund it more aggressively. I'm sure you'll mention something about my number of holdings, and I understand it's a lot, but you're self-aware, that's good. But I consider investing a good hobby of mine. I check the news and track the stocks I own on a daily basis, and I make adjustments where there is important news on the investment I hold. Just wondering what you think about my current portfolio and if you have any suggestions for my scenario. Well, hey, Adam, thank you so much. I think this is really interesting. There's a couple of things that I want to touch on here really quick. First thing is, it sounds like you're fairly new to investing. It's an interesting topic. It's a hobby of yours. You write here, hobby. This is the only thing that scares me when I read this or concerns me. On a daily basis, you're tracking your stocks. This is not a good thing. Investing is not a short-term action. It's a long one of the greatest quotes that I love from Warren Buffett is him talking about, if you're going to invest in decades. A decade is a long time. It's an incredibly long time. And I think, there's also really great quotes from Warren Buffett around, if you have a farm, you don't look and watch your crops grow on a daily basis. You don't want to do that. I like that it's a hobby, but how long is it going to be a hobby of yours? You may have other interests come up. You may meet somebody and get married and have kids, and that hobby may dwindle away. It may still be an interest, but maybe no longer a hobby that you can focus on a daily basis. And I am living proof of exactly this. Before, getting married and having kids, I would do this every single day. I still kind of do because I'm a freaking nerd and I love it. But I've noticed with having a kid, I have less time. With working full time, I have less time. And so what I've learned is the more you can make your portfolio passive, the better you're going to be or set up for success over the long term. And it's going to help you think in decades. Okay, so that's the only thing that I would say here. When it comes to the side hustles, I love it, man. One of the best things that you can do in your early 20s is get a great job, find a stable partner, have similar goals in mind, make sure you don't get into consumer debt, put together a plan. You still want to live a little, you want to travel, you want to have fun, you got a budget. House hacking is probably the most important thing that you can do in your early 20s. If you can somehow find a way to lower your housing costs, you're going to really, really be set up for success. And that is for your average American, your average person abroad. Your housing costs, your shelter costs are usually your highest. If you can somehow hack that, have a roommate, live with your parents, do something, that's going to really snowball or just accelerate your path to growth and to wealth much faster. So that's just some initial thoughts there. Let's take a look at your portfolio. All right, so the chart here is not working, so we're not going to be able to see the historical performance. A couple things right off the bat. I like that you have a low expense ratio. I think you have a healthy dividend. Now, you didn't say your time, well, you did say your time horizon a little bit, your 30s or 40s, you know, to maybe supplement your portfolio or your income. I like that. 60 holdings is probably too much. So realistically, I think I would encourage you to maybe look at a way. It doesn't make sense. So when I say only, don't, it's all relative. $6,500 to me when I was 23 was a hell of a lot of money. Today, it's not as much money to me because I'm older. I make more money now than I used to. So that's what I mean. And my expenses are different. That's why I always try to say it's relative when you look at the dollar amounts. But here's something that I would encourage you to do. Look through every single one of your companies here and ask the question, do you understand the business? Do you understand how they generate revenue? I would encourage you to maybe consider trimming this in half, or at least thinking, maybe reassessing, is this the right approach for you? Right? Do you really want to do this? And I can promise you in 5 years, 10 years, once you have kids, married, family, all of that good stuff, career, you're going to have less time. And this is going to transition from being a hobby to maybe even a burden. So right now, it may be a good choice while you're starting out to set it up where you have fewer holdings and just kind of declutter, right? Declutter it. All right, so let's look at your slices. You got most in consumer, tech, real estate, healthcare, finance. You said you're in your early 20s. Do you have a Roth IRA? It may make sense to even completely transition real estate into your Roth IRA. And then you say that you want to maybe lean on your portfolio when you're 30 or 40. Why not add real estate in 10 years? Why do you need to have it right now? Like, yeah, you can compound it and you can grow it, but you're paying a higher tax rate when you do that. So that's something that I would definitely consider. Everyone that's in this boat, they're maybe in their early 20s. If you know you have a 20-year time horizon, why not add real estate in 10 years? Or if you want to have it from day one, put it in a Roth IRA, a tax sheltered account, because you can always add this in 10 or 15 years. And then you can focus on it more heavily, but this way you're optimizing for tax efficiency. Okay, something to consider. I think it would be a value for the majority of people watching this video. So let's see here. What do you got in here in consumers? Right off the bat, you got a lot of great brands. You got the Pepsi, Costco, Target, Procter & Gamble. I like every single one of these companies. Comcast is a little bit of you just label this as consumer. Okay, that's fine. I like this because they're all really well-known brand names, right? Clorox, Nike, McDonald's, Disney, Lowe's. Half of these I own in my own portfolio. Pepsi is one of my favorite companies of all time. Target, one of my favorite companies. They just increased their dividend incredibly. Lowe's, one of my favorite retailers as well, just raised their dividend. McDonald's, one of the best recession-proof companies out there, along with Clorox. Really, really great brands in here. What do you got here in tech? Apple, Microsoft, Broadcom, Oracle, Cisco. Also really, really great companies, really great software companies. I work in tech, and all five of these are great software companies. They have their own economic moat in their own way in the segments that they operate in. I think this is fine. Let's check real estate store, Realty Income, VC, Prologis, Land, AMT. These are really, I'm not the biggest fan of NRZ. The rest of them, so I'm not the biggest fan of NRZ, but the rest of them I really, really like. Like I said, I think if I was if I was early 20s and if I knew what I know today, I would put this in a Roth IRA or maybe even lower this to 5%. Right? The taxes, maybe right now it's not a big deal because you're still going to school, but once you get older and you start making more money, this is going to become a bigger topic that you're going to have on your mind. Once you file your taxes and you see the tax return and you're going to see how much you owe, it's not going to be very much fun. Let's take a look at healthcare. Really, really great companies. I think there's too many here. I personally, these are all really great companies. Do you really need all of them? Do you need Abbott? Do you also need Merck? Do you also need Pfizer? These are like Johnson & Johnson. Yes, it's a little bit different because it has consumer and pharmaceutical, but you also have consumers here. So there's a little bit of a blend. I like Medtronics. So yeah, once again, as I mentioned earlier, look at every single one of these companies. Do you know how they generate revenue? If you don't, consider scrapping them is how I would view it. Financials, okay. Some bigger companies, bigger brands, MasterCard, Visa, TD. Yeah. I mean, they're all really, really great companies. I don't really have anything negative to say about any of these companies. Same with these. These are all like, this is the challenging thing when you're picking individual stocks. When you go through the list and you screen for dividend growth, payout ratio, dividend yield, these are all really, really great companies. You have them equally weighted. I can't really say much to the actual individual holdings. I like this. 3M good, Waste Management good, Union Pacific, Honeywell good, Caterpillar good. They just raised their dividend. Lockheed Martin good. I'm not too familiar with the last two here. There's a lot of them. I mean, it's a lot of individual companies. What do you got in here? You got JEPI, SHD, and DGRO. Okay, I do like this. I do like this. JEPI, do you really need it for a 20-year time horizon? The answer is probably no. But if you want to keep it in there, it's fine. What do you got in here is a very low percentage. SHD and DGRO, I like it. Income, AT&T, it's a telecom. Verizon, it's a telecom. You also had Comcast here as well. Okay. All right. So here's my thoughts. As I mentioned a little bit earlier, right now it's a hobby of yours. You enjoy it. If in the future you decided, hey, I want to make this a little bit more seamless, you know what you can do is you can make this 50%. You could make the income portfolio 50%. And if you do that, I would highly encourage lowering JEPI to like 10%, quite honest. And then I would increase SHD and DGRO. These two, all three of these I own. SHD and DGRO, and then VOIM as well are my favorite dividend growth ETFs. I really, really like them. So if you did decide, hey, I want to make this a little bit more seamless for me, a little bit less manual, you could increase the income fund. You could reassess, evaluate whether or not you wanted to hold some of the individual ones in there. And that's what you could do. But for the portfolio yield, it might actually be a good thing to get this down because you don't need the income today. If you could get this down to like a 2%, that would be on par with the S&P 500. I think that, me personally, with the 20-year time horizon, I've tried to get this down to about a 2% starting yield because then it's focused more on the capital appreciation and the growth. So just some thoughts there. Adam, thank you so much for sending over your portfolio. I hope that this was helpful. All right, let's take a look at the next portfolio here from Greg. He writes, hey, Jake, thank you for taking your time to review my portfolio. I really enjoy your content and value your opinion. Well, Greg, thank you so much, man. I appreciate it. My name is Greg. I'm 33 years old, and I'm from Scotland. I also spent 4 years living in Paderborn, Germany, whilst I was serving in the Army. My investing journey started fairly recently at the start of the pandemic. After selling my flat and moving in with my partner, Christine, I invested into stocks and some crypto, the timing being pretty perfect as the market was down quite a bit. Focusing mainly on dividend stocks and a few growth stocks, I did quite well and made some nice gains, but sold out of my positions after about a year of holding them after reevaluating my financial goals and cutting back on spending. My partner and I have decided to sell our property and buy a van with the goal of converting it into a living space, hopefully keeping our outgoings to a minimum. I've started a new portfolio in the last few weeks. I dollar cost average into it every week, whilst also saving up an emergency fund and a cash pot for the inevitable recession. I currently only have 20 positions, which are all individual stocks. The broker I use is Trading 212, and I use their individual savings account, which is tax-free. The link is below, and I've attached the Google spreadsheet. Okay, well, this is cool, man. So you bought a van. Are you going to go live down by the river? I actually Tommy Boy and Chris Farley. Oh my gosh, Down by the River. Let me know if you know that reference. I bet half of the people watching this video don't know that reference. Down by the river. You can get those, what are those things from Elon Musk? The Starlinks, you can get internet anywhere. So if you're in a van, if you would have been living the van life 10 years ago or 5 years ago, internet would have been more difficult. Now you got Starlink, you can get internet anywhere. I think it is so cool. All right, so let's take a look at your portfolio here. You got 20 holdings. And you said you're only investing in individual stocks. I would kind of challenge you on that. Maybe you want to consider ETFs. I love ETFs. I think they're a great way to build generational wealth, and it's a great way to reduce your stress, and ultimately just because, we just can't predict the future. So that's a big reason why I like ETFs. Your largest holdings are Microsoft and Apple. You pretty much got an index here with Microsoft and Apple being the largest holdings. You got Intel, Qualcomm, so pretty heavy in tech. You got Comcast, you got Nvidia, you got Tyson Foods, you got Lowe's, Target, and Home Depot. Okay, so this is cool. Everybody that is new to investing or dividend investing, one thing that you'll notice right off the bat is Home Depot, Target, and Lowe's are kind of bucketed in a similar way. Tyson Foods a little bit. Nvidia is fundamentally different than Home Depot, though it is a dividend stock. It pays a very, very low starting dividend yield today. It's more of a growth stock, but they do pay a dividend. So you can see this. You can be a dividend investor and invest into technology, right? Half of this is technology, and then the other half is more your traditional brick and mortar retail. What do you got in the other one here? Speaking of brick and mortar retail, you got Costco, you got Union Pacific, you got UPS, FedEx, 10% in transportation. Okay, cool. Lockheed Martin, Johnson & Johnson, 3M, Pepsi, McDonald's, and JP Morgan. So what I do like is you got a little bit of distribution across multiple sectors. You got financials, you got consumers, you got industrials, you got healthcare, you got retail, you got tech, you got telecom with Comcast, I believe. So you're well diversified in terms of the different industries that you have. You don't have too crazy of target allocation. I think your largest holdings were Apple and Microsoft at 7%. I kind of like keeping it down at 5%, but that's fine. I like the fact that these are all household brand names, right? Johnson & Johnson, some of the best companies in the world. These companies, like if you're going to own individual stocks, I like these. I like these a lot. I don't think any of these companies are going to go away anytime soon. And the best thing about this portfolio here is a lot of these are recession proof, right? A lot of these are going to actually perform well relative to the overall market in a down market. And the best thing about the majority of these companies, this is the key thing, everybody. The best thing about these companies is they have pricing power. That is what makes them recession proof. McDonald's has pricing power. Lockheed Martin has pricing power. Union Pacific has pricing power. Costco has pricing power within reason. They have their own in-house brand with Kirkland. They can price it, they have pricing power. This is really, really great. And when you use the words inevitable recession, this is a type of portfolio that you can sleep well at night. And I would argue if you added a layer of index funds, you'd probably sleep even better. But we'll leave that for another day. So thank you so much for sending over your portfolio. I really, really like it. All right, let's take a look at the last portfolio here from Mo. He writes, "Hi Jake, I came across your channel not too long ago and I'm so grateful I did. I wanted to use this opportunity to thank you for helping people like me and especially not forcing us to buy a program. That is very noble of you, and I pray God bless you for that. Thank you, Mo. I appreciate it. I've never sold a course. I never plan on selling a course. I just don't know. Like, I started YouTube never with the intention to make money. It was always like, hey, I think I could help some people. I love talking about stocks and investing. I don't know a lot of people around me who I live around to talk about investing. So I thought, you know what? Hey, let's create YouTube videos and talk about it online. And, that's kind of how it started out. So I started investing last year when the pandemic hit. So I'm still very new at this, though I'm doing everything I can to learn. Okay, great. I know you're not a financial advisor, Jake, but I really do need your help with my accounts, especially in regards to the asset allocation and diversification. I'm not entirely sure what I'm doing, but I'm dollar cost averaging regardless. I was hoping you can take a look at my accounts and help me with a simple to follow strategy. I can set and forget, or perhaps just rebalance once a year. I'm 48 years old, a single mom of 3, and my goals are to have enough money, about $500 a month at retirement, travel the world, and also leave a legacy for my kids 10 years or less. So you're 48 years old. You're looking to have about $500 a month. Okay, we can work through that. I'm currently maximizing my TSP. TSP is a government issued account. your HSA, your Roth IRA, your taxable. Wow, this is actually really incredible. All these accounts that you're working on, your REITs. I've attached copies of my retirement brokerage. Thank you very much for retirement. You're saying the birth of your son. Mo, thank you so much. Thank you so much. I really appreciate this. I think this is so great. You're 48 years old. You're a single mom of 3, and you have a plan. You're trying to build generational wealth for your kids. I think this is absolutely incredible. So it looks like that you're a little bit more ahead of the game when it comes to the different types of accounts. You have your retirement account, your HSA, your Roth, your taxable, you have REITs. It sounds like you're down the right path. What it sounds like is what you need is to really just simplify it, right? You don't need to overcomplicate it, right? For example, what if something were to happen to you in 10 years or 20 years or 30 years or whatever? Are your kids going to be able to take over your finances? Are they going to know what you intended? Is it going to be too complicated? Like, those are the things that you start thinking about later in life, and that's why it's so important that we simplify our lives, because the unexpected happens all the time. All right, let's take a look at your taxable account first. We can't see the historical performance past May of this year. You have a good healthy expense ratio. You have a healthy dividend yield. You have 28 holdings. Do you have 28 holdings? Where are the 28 holdings? Am I confused? Oh, you know what you did here? It looks like you shared a slice. Am I looking at this right? No, why am I? Oh, this is, here it is. The reason why I was confused, I thought this was a slice within a slice, but this right here is a whole nother slice. If it will pull up. Oh, it's one of those in M1 Finance that is glitching. Oh, it's not working. Okay, so this is not going to work. It's not going to let me look at the Berkshire Hathaway slice that has individual companies in here. So this is a slice from M1 Finance. And so if you do have M1 Finance, you can go in and you can click it, and it will have Berkshire Hathaway companies. I believe I'm almost positive that that's what it is. If somebody in the comments wants to confirm that, they can do that, but I'm almost positive that's what it is. All right, so let's take a look. We're not going to be able to look at that, but we're going to be able to look at these right here. I like that you have a lot of exposure into ETFs. You have the total stock market. You have the total world market. I like that. You have QQQ. I like that. Though you're probably down 30% this year with QQQ, but you just dollar cost average. You got oil, okay, emerging markets, VEA, Medtronics, and BNDX. Okay, so you said you wanted to simplify your life. Let me tell you this. In my opinion, you don't need these. The VWO and the VEA, you don't need this because you have VT. VT has all of this already in it. So if you really, really wanted to simplify your life, you could take this 10% and you could make this 19%, for example. VT is the total world market. So if the world becomes more productive and more prosperous, and then VT will also go up. It's the same concept with VTI. The only difference with VTI is this is just the US, and this right here has 60% of the US and 40% international. There's no bonds in there. There's no bonds. It's just individual equities. So if you did want to have a different one for bonds, you could do that. But that's how I would personally do it. You could focus on VTI, VT, and then you could maybe have a little bit in QQQ for the growth. You could have a little bit in Berkshire Hathaway if you wanted to. I don't think you have to. And then you got Medtronic in here. Maybe you work in the healthcare industry. Maybe you work at a healthcare facility through the government or something, or maybe your supplier is Medtronics. I don't know. There's probably some association there. You probably know them from somewhere. So that's kind of that. But yeah, I guess when it comes to this, I would consider really just extra simplifying it, focusing heavily on VTI like you are, VT, maybe QQQ, and then if you wanted to have Berkshire Hathaway, go for it. I like that. Let's take a look at your Roth IRA. Your Roth IRA is simple. You got the Schwab Large Cap Value, SCHD, my favorite dividend ETF. You got VNQ, VPU, and BLV. Yeah, I think this is fine. you're 48 years old, you have bond exposure in here. This is more focused on the dividend, but this is a high quality Roth IRA because you're focused on large cap value. SHD, it's really focused on quality dividend companies. VNQ is a really high quality real estate REIT ETF. VPU is good. It's a higher dividend utility ETF fund, sector ETF from Vanguard, and a long-term bond. Yeah, I think this is fine. I like it. I like this a little bit more than your individual account. I like it how it has only 5 holdings. It's simplified. You got 35, 30, it's just easier, a little bit more straightforward. I would recommend making your taxable account similar to how your Roth IRA is. Just keep it very straightforward, very simple. That's just kind of how I look at it, how I would recommend doing it. What you could even consider doing is you could even put in VTI in here, or VOO is something you can maybe consider. If you really, really wanted to be a little bit more conservative, you could put VOO. But this is a dividend portfolio. It's focused primarily on dividend because you can see it has a higher dividend than the S&P 500. I like it. I think it's absolutely fine. This one will probably underperform the S&P 500 from a total returns point of view over the long term, but you are focused on quality. You do have a higher dividend. It's simple. I think it's fine. So yeah, that's kind of my 2 cents there. With this one, yeah, I would definitely revisit this one and maybe make it a little bit more simple, maybe narrow it down to maybe 5 different holdings is what I would recommend there. So, but yeah, thank you, Mo. Thank you so much for sending over your portfolio. I hope that this is helpful. The next thing is dollar cost averaging, maximizing these different retirement accounts, your HSA like you already are, and then really educating your kids and educating them and helping them understand and become financially literate. But yeah, I think this is great. You're thinking about your kids, you're thinking about your finances. You want to set them up for success. And but I think one of the best things that you can do is not just leaving them money. Don't leave them just a big portfolio behind when you pass, but rather leave with them, financial literacy, financial education, so that they can make educated decisions for themselves, so that they can set up their lives for success. And so I think that's how you really, really leave generational wealth, is passing on that knowledge to your kids so that they're set up and that they can make sound financial decisions. Thank you so much for watching, everybody. If you want me to review your portfolio in a future video, you can send me an email and I will do my best to include your portfolio in a future Review My Pie video. Hope everybody has a great week, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.